Wednesday, January 22nd, 2020, Maneco 64, home of alternative economics and contrarian views. This morning, I want to talk about leverage, derivatives, how they are the Achilles heel of the current financial system, and leverage basically is a lot of debt. Yes, our economy, our credit-based economy is also based on leverage or debt, and that as well is the Achilles heel of our economy. But it starts in the financial system, which provides the credit and liquidity for the economy. The repo market, of course, I've spoken many times about it in the last 6 months. I started talking about the repo market in September. That is a problem, of course, but the repo market is only a symptom of the leverage and the derivatives. And why derivatives? Well, because derivatives use leverage. They keep the trades off balance sheet of the institutions that deal in those derivatives, and they leverage as well. And there are two kinds of derivatives. There are the exchange traded derivatives, which I worked in as a futures and options broker, like the CME exchange. Well, and before, when I started out, all the exchanges were private exchanges. They were not publicly held companies. So we had a lot more exchanges, of course. The members of the exchanges held the seats. They owned the exchange. Now it's completely different, of course. And then you have the over-the-counter derivatives. And they're even worse. They're probably even more leveraged than, for example, the exchange-traded derivatives. In the exchange-traded derivatives as well, the information is publicly available to everyone to see about open interest, about margin, about volume of all the contracts. While in the OTC, it's very opaque, not transparent at all. Basically, the OTC derivatives is when an institution, let's say a treasury for a big corporation, calls JP Morgan, Goldman Sachs, or any other investment bank and asks them to write up a derivative contract for them over the counter. They'll tailor it to the institution. They'll agree on the terms, the leverage and everything. We know that there's probably more than $1 quadrillion of notional derivatives exposure out there. What's a quadrillion? Well, it's 1,000 trillion. It's a huge number, of course. And what's notional? Well, notional, for example, if you trade a gold future, which is 100 ounces, right now at 1560 almost, that means you control $156,000 of gold. The margin, initial margin is just under 5,000. That's the initial margin. And then there's the maintenance margin, which was also about 4.5, maybe a little more. So that's like just under $10,000. That's all you need to control the notional amount of 156,000. So yes, by having a quadrillion in notional doesn't mean that money's out there to pay off the derivatives trade. And of course, the argument by the bankers and the speculators is that derivatives net out, so you're never going to have to pay the whole notional amount. But there is a time when that is not true. That's when one of the counterparty fails, like we had during the 08 crisis when Lehman failed, AIG Financial Products failed. AIG Financial Products, they were involved in the over-the-counter derivatives. They actually insured some of these derivatives, so it's crazy. And how leveraged are the derivatives? Well, I'll give you an example. The most traded, probably the most liquid bond derivative is the 10-year note future, traded on the CME. Got some information here about the margins. So for a speculative account, the initial margin is just under $3,000. The maintenance margin is about $2,200. The futures contract for the 10-year note future is $100,000 notional amount, but with the price at 129, it's worth $129,000. So you add up those margins, it's around 4% of the amount you control. That's for the speculators. For the hedgers is a little less. So that means that speculators are leveraged 25 times if they only have to put 4% down. And then aside from that, what the speculators will do, or the hedge funds, is that they will take some of their safer assets and lend it in the repo market to get even more leverage. They're not happy with 25 to 1. And there's been an article out from the BIS talking about how hedge funds have been at the heart of the problem of the repo market. They're doing what's called a basis trade. Basically, arbing the difference, the slight difference between the cash 10-year note futures, or other, maybe the 5-year note as well, future, and the cash 10-year note. They're arbing the little difference there, the bases. They wouldn't make a lot of money if they did it like not leveraged. So aside from the 25 to 1 in the futures, they're getting leverage in the repo. And so what the Federal Reserve is doing by assisting the repo market, by keeping it going. And why is the repo market seizing up? Well, because the banks that are involved in this, in the repo market, they can see that these speculators are overdoing it. They don't want to lend it to them. They know it's trouble. So the Feds had to step in to bail out the system. Why bail out the system? Well, because these hedge fund speculators, they become so huge that if there's trouble in their leverage positions, what they'll have to do is to liquidate other positions. And that could create a cascading effect in the whole financial system. Asset prices could collapse. It could start, a waterfall, an avalanche, whatever you want to call it, because it's not only the hedge funds that are leveraged, the banks are leveraged. Don't forget, a lot of the hedge funds have, in the last few years, been created by people or traders that work for banks. And why do they do that? Well, a lot of times the banks didn't want to keep the kind of trading that these traders do on the banks, on the bank's books, but they still want the profit. So they basically help these people set up hedge funds, and they know all the hedge fund traders because they used to work for them. So they know what's going on, all the leverage. So that's the problem. It's the leverage. It's the debt. It's the same thing that happened in the 1920s. People were greedy. So how does leverage work? Basically, you take on debt to try to maximize your profit. Let's say you have $100. If you bet on the price of 10-year note futures with $100 and you didn't leverage, you might make, who knows, $2, $3 if the price moves. But if you can leverage 25 to 1, you can make a lot more if the price goes your way. The flip side is that if the market goes against you, you could lose a lot more than the $100 that you put in. And that's the problem with leverage. And that's the problem with our economy our economies around the world, especially the Western economies, the average consumer, average individual out there, if they don't borrow, they can't survive. So companies as well, they've got the what's called just-in-time inventory, and it's all based on credit and debt. They don't run, how can I say, without any leverage. So I would say, yeah, keep an eye on the repo market. The Federal Reserve is supposed to wean out or phase out the help of the repo market, but I think it's only going to get worse. And it's amazing how the Fed's original mandate has changed. It used to be that they were there to maintain liquidity for the banks and the commercial system, the real economy. Now they're there to maintain the speculators, the hedge funds. And why is that? Well, because they've built a monster of a system. They've leveraged it so much. There's a bubble in everything, like the stock market, the bond market. And if they don't keep these speculators whole, the whole thing implodes. And it's all to do with leverage and greed. So let's look at where the markets are this morning. Yesterday, the markets came off, the stock markets. The Dow was down just over 0.5%, 152 points. S&P was down half of that in percentage terms, so it didn't do as badly. So right now it's 8:15 a.m. London time. We've got gold down 3.5 at 1554.50. Yesterday gold had a very wild ride, got up to 1568 early on, dropped as low as I think 1546 or thereabouts, and actually closed fairly strongly at just below 1560. So I still think we're seeing consolidation in gold, just like we saw a consolidation in the previous move up from 1480 to 1610. In the middle of that move, if you have a look, gold consolidated for a few weeks before moving higher. So that's where I think we are. Silver, of course, gets hit very hard usually, even harder than gold when gold gets hit. So it traded down to 1767, I think, yesterday. Right now, it's unchanged at 1778. The Dow is up 110 today. So the futures up just over a third. S&P is up a third as well. And the NASDAQ 100 futures up 0.5%. So things are kind of choppy right now, not only in the stock market, but precious metals. Sterling is down slightly, or cable, 130.44. I think the highs yesterday were around 130.72. Euro is at 110.78, pretty much unchanged overnight. Dollar is up 0.1 versus the yen, just below 110. And the dollar is unchanged against the Chinese yuan at 690. Crude oil right now, WTI is down 0.2%, just below $58. Brent is at 63.68, down just under 0.2%. Bond market yesterday with a drop in the stock market, which wasn't really huge. 10-year yields dropped about 6 basis points to around 177. Right now we're at 178, so up 1 basis point. There you go. It's amazing because if you're not aware or familiar with financial markets, if you're just an average person out there on the street, and you look at CNBC, all the reporting of the markets, you don't realize how much of a casino all the markets are, how leveraged they are. And someone just tweeted to me. I got a notification and didn't go through it, but apparently President Trump made a joke about negative interest rates, that they're going to get negative interest rates. I haven't really looked into it, but I'm not surprised because the system can only keep going with cheaper and cheaper credit. Negative interest rates is the epitome of cheap credit. They're actually paying you to take on more credit because they're afraid that the whole house of cards is going to implode. Do you play that game? Well, that's up to you. I'm going to stay out of it and be a spectator from the outside. So if you enjoyed this video, please hit the like button. Think about subscribing if you're not a subscriber yet. Make sure you hit that little notification bell above to be notified of all my new videos. Please share this video far and wide as well. And you can also follow me on Twitter, BitChute, DTube, and Steemit. Wish you all a great day. Take care. Bye.